You are listening to Uranium Spotlight on Tuesday, March 25th, 2025. Brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, more production setbacks. The U.S. shoots for uranium self-sufficiency. What is driving uranium markets? And NextGen releases new exploration results. Last week, the uranium spot price climbed by $1 to $64.70 a pound U3O8, up from $63.70 a pound. The move came during a week of slight trading where modest early bidding pushed prices higher before easing slightly by week's end. All four major spot price indicators posted gains. UxC's benchmark rose to $64.45, Cameco's CMC price reached $64, Orano's Oro climbed to $64.50, and Coverdyne's CVD came in at $65.25, posting the smallest increase of the group. Notably, Orano's price moved the most, adding $1.50 on the week. For uranium equity investors, the key takeaway is that prices are rising on minimal volume, a signal of just how tight the market has become. Sellers have increasingly holding out for higher pricing, and it doesn't take much activity to shift the market, an important dynamic when evaluating near-term equity volatility. Looking ahead, U.S. utilities remain largely on the sidelines, delaying purchases amid tariff uncertainty. But the demand hasn't disappeared, it's been deferred. Once there's clarity on trade policy, the buying will resume, likely at higher prices. And since the bulk of uranium is sold under long-term contracts, these spot movements often serve as a bellwether for broader pricing momentum. In summary, last week's gains, despite muted trading, highlight a uranium market that continues to firm up underneath the surface. For those watching equities, it's another sign that fundamentals, not just flow, are in control. Paladin Energy has temporarily shut down its Langer Heinrich uranium mine in Namibia due to heavy rainfall in the region, the company announced this Friday. On top of the weather-related disruption, Paladin has lowered its 2025 production guidance from 4 to 4.5 million pounds of U3O8 to 3 to 3.6 million pounds, citing ongoing operational challenges and delays in ramp-up. Langer Heinrich has only recently re-entered production and was expected to contribute around 600,000 pounds annually in its current phase. The company hasn't given a clear timeline for whether the weather will improve or how quickly the mine can resume operations. While the full impact of the shutdown is still uncertain, the immediate consequence is a reduction in available supply at a time when the market is already in a deep structural deficit. The world's nuclear reactors require roughly 180 million pounds of uranium annually, but only 132 million pounds were produced last year, a shortfall of about 48 million pounds. This comes on the heels of earlier production setbacks. Kazatomprom was forced to shut down operations at its Inkai joint venture due to flooding and continues to face shortages of sulfuric acid essential to ISR operations in Kazakhstan. Now, with Paladin adding to the list of disruptions, global production in 2025 could fall short of even last year's already inadequate levels. On the demand side, momentum continues to build. 60 reactors are currently under construction worldwide, pushing long-term demand even higher. While several mothballed mines were brought back online in 2024 as prices surged, that wave of restarts has since stalled. Orano has hinted it may revive a dormant project in Namibia, but that remains speculative. Meanwhile, NextGen's flagship Rook I project in Canada is still awaiting federal environmental approval, a reminder that new mines face permitting timelines of 10 to 15 years before meaningful production can begin. So while uranium prices have eased from last year's highs, persistent supply disruptions, combined with growing demand and limited near-term production upside, suggest the pullback may be short-lived. The market is tightening again, and uranium equities could be among the first to reflect that shift. Following last week's discussion on Trump administration's push for energy maximization and the latest U.S. Energy Information Agency report on domestic uranium production, this week brought a new development: the announcement of an executive order aimed at boosting domestic output of uranium and other critical minerals. The order invokes the Defense Production Act, a wartime authority last used by the Biden administration to accelerate mineral production. But the impact may be limited. At $50 a pound, the U.S. has an estimated 523 million pounds of uranium resources. At $100 a pound, that figure rises to 1.2 billion pounds. Even so, those higher cost reserves would only supply the U.S. for roughly 23 years at current consumption levels. Canada, by comparison, holds about 1.5 billion pounds of recoverable uranium at just $60 a pound, and it's not just about volume. Canada's deposits are the highest grade in the world, making them far more economically efficient to mine and process. While the U.S. attempts to reduce reliance on foreign uranium through tariffs and emergency powers, the economics are simply not in favor. U.S. mine capacity today is insufficient, and meaningful new domestic production would take 10 to 15 years to materialize, time the U.S. nuclear sector does not have. Canada is already the U.S.'s largest uranium supplier, providing 27% of its imports in a market where 99% of uranium is currently sourced from abroad. Attempting to pivot rapidly to domestic supply under these conditions will almost certainly drive up costs for U.S. utilities. While expanding U.S. production makes strategic sense amid today's supply deficit, doing so at the expense of a stable allied trading partner like Canada may prove both costly and counterproductive. The uranium market continues to wrestle with uncertainty as trade policies shift unpredictably. Tariffs are imposed, then postponed, sometimes more than once, while geopolitical tensions escalate globally. Canada remains caught in the crosshairs of a tariff policy where Russia faces a full ban on uranium imports to the U.S. Yet, paradoxically, Russia's influence appears to be rising amid signals of diplomatic softening from the Trump administration. Meanwhile, Canada's trade position becomes more precarious, with the U.S. administration seemingly pressing to address perceived trade imbalances, if not seeking broader concessions. Amid this confusion, uranium equities have taken a hit, and many investors are pointing to the falling spot price as the culprit. But it's essential to put that in context. Only about 5% of global uranium transactions occur on the spot market. The remaining 95% are done through long-term contracts where prices have been steadily climbing. Analysts continue to forecast strong long-term demand growth even as supply tightens. One driver of the recent spot market slowdown is that U.S. utilities have paused new purchases, largely due to uncertainty around tariffs. However, that's a temporary condition. Once the regulatory landscape stabilizes, utilities will need to return to market to rebuild their inventories. Separately, some investors have been spooked by recent developments in artificial intelligence, particularly DeepSeek's breakthroughs in chip efficiency and reduced energy demands. There's a growing narrative suggesting that AI data centers may no longer need the kind of robust baseload power nuclear offers. That view is short-sighted. The uranium investment thesis was never built solely around AI, or the promise of SMRs powering server farms. While the connection added some speculative upside, the real story is much larger. Growing global electricity demand, aging reactor fleets, and long-term underinvestment in supply. AI might shift around the edges, but it was never going to move the needle more than a few dollars a pound over the next 2 decades. In short, this period of volatility, driven by headlines more than fundamentals, has created unnecessary turmoil. But the underlying uranium market remains structurally strong, and that should reassert itself over time. NextGen has just announced what it's calling the best discovery phase hole in the company's history, outperforming even early drilling at its world-class Arrow deposit. Hole RK25232 at the Patterson Corridor East, or PCE, hit 3.9 meters of over 61,000 counts per second within a broader 13.8 meter mineralized zone starting at about 452 meters depth. This is a shallow intercept in competent basement rock and remains open in all directions, including 300 meters up dip. Importantly, 4 other holes, each at least 50 meters away, also hit high-grade uranium, effectively doubling the size of the high-grade subdomain to 210 meters in strike and 335 meters vertically since November. For context, this intensity of mineralization wasn't seen at Arrow until NextGen was well into the delineation stage. So to see this at such an early point in the PCE program suggests a very large, highly prospective mineralizing system. NextGen believes the scale here could rival Arrow, and the market will be watching closely as they follow up. What's also notable, this zone sits just south of Purepoint's Hook Lake joint venture, which shares the same structural corridor. That's the kind of regional mineralizing event that doesn't stop at property lines, and Purepoint shareholders will be paying attention. Assay results are expected in April, and with uranium prices holding firm, this discovery could inject fresh momentum into exploration equities across the basin. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.